So we'll go ahead and get started. Welcome to my 10th Masterclass on investing. This course is designed to teach you how to earn long-term wealth in the stock market. So building long-term wealth is everything. And at the beginning of this presentation, there's a quote, and I basically just wrote that building wealth is a marathon, it's not a sprint, and discipline is the key ingredient. This is a topic that's going to come up time and time again as we go through this presentation, but the key is to being disciplined and having emotional intelligence and just realizing that in order to build long-term wealth, it's not going to happen overnight. So before we get into it, I'll just kind of start by introducing my brand to you. So my brand is the Millennial Money Guide, which is both a financial literacy company and a podcast. So right now we are working with millennials, which, by the way, anyone between the ages of 25 and 41 is technically a millennial. As of this moment, I'm really trying to work with women to teach them how to win with their money. A common question that I get is, well, do you work with men? I do work with men, but personally for me, because of how I was raised by a strong single mom who I saw struggling quite a bit with money. Personally, for myself, I just feel very empowered when I help other young women. So right now, through my financial literacy company, we're teaching women how to get to millionaire status in their lifetime. And we do that by teaching them that they don't have to give up everything they love. So that means if you love drinking Starbucks every day, you don't have to cut out your favorite Starbucks drink in order to build wealth, but you do have to make sure that your purchases are aligned with your purpose. So when it comes to finance, generally speaking, through both my podcast and my company, I apply a holistic approach to finance. So that means that I don't just focus on investing. Yes, the purpose of today is to focus on investing because it plays such a pivotal role in your ability to work towards financial freedom. But I think that there are a lot of other building blocks that you need to kind of have secured in order to work towards financial freedom. So that could be budgeting, that could be learning how to manage your debt, whether it's student loans, even a mortgage. A mortgage is the biggest debt that you'll ever take on in your life, but obviously it's also one of the best debts that you can take on. So I teach my clients how to leverage debt and build long-term wealth. I teach them how to invest. I teach them how to build an excellent credit score, because I see all of these moving parts as a part of a formula that helps you live a more fulfilled life that's full of opportunities. In terms of who I am, my name is Gina, and I've worked in finance for 6 years. A lot of my experience comes from hands-on experience working at a financial institution where I got a number of different financial designations. Over the last 6 years, I worked with thousands of Canadians and I helped them improve their overall financial well-being. Last year, I incorporated my company, and over the span of a year, I built a portfolio of about 700 clients all across the globe, where they either worked one-on-one with me, or they signed up for my classes, or they went through my coaching program. So currently we're on a mission to empower young women all across the globe to take control of their financial future. And my goal is to help my clients reach millionaire status in their lifetime. And by working with me, they're going to get there faster than if they tried to do it on their own. As we speak, the MMG is going through a massive growth period. There's a huge need for financial education, and our goal is to make an impact on a global scale when it comes to financial literacy. So let's start with the absolute basics. What is investing? Investing is the idea that you're taking your money and you're allocating it into an investment vehicle with the expectation of generating an income or a profit. So basically what you're saying is, hey, I have X amount of money, I want to make it grow, so I'm going to throw it into some sort of an investment vehicle or multiple vehicles in order to make that balance grow, or to earn passive income through dividends or just some sort of an income through this investment vehicle. In terms of why you should invest, there's so many reasons as to why you should invest. There's a number of reasons. One is to build wealth. Think about like intergenerational wealth, making sure that future generations are taken care of, saving for retirement. And I always pause and I ask you guys a question, which is, how much do you think you need to have saved by retirement? Like, if there's a number you had to throw out there, what do you think the magic number is? Feel free to utilize the chat box. Someone said 1 million. Any other guesses? Another 1 million. 100 million. Okay. You guys nailed it. So generally speaking, they're saying 1 million. I actually say 1.3 million. If you make $60,000 annually and you want to retire comfortably by the time you're 65, you actually need $1.3 million saved. So every single person that's in this presentation right now, I need you to actually think about how you're going to save $1.3 million by the time you turn 60. Are you doing it right now? Obviously, there's a number of ways that you can do this, but investing in the stock market is one of the best ways to save for retirement. Purchasing real estate is another great way. But again, you need to invest your money in order to have enough saved for even a down payment. And I'll pause for a second again. On average, how many years do you think it takes a millennial to save for a down payment? Like, throw a number out. How long do you think you would need to save in order to be able to purchase a property here on your own if you had no help? 10 years, 5 years, 25, 10. It takes millennials 13 years to save for a down payment. So again, as a residential mortgage broker, which I didn't mention that earlier on, I am a licensed mortgage broker as well. And one of the biggest downfalls for our generation is that we just don't have enough saved for a down payment. And had that person started when they were like 20 or 21 with as little as $250, it would have made the biggest difference. So your key takeaway should be that I need to start now and I don't need to put this off any longer. And not a lot of people have like parents that are willing to gift them money either. So if you're someone that knows that they're not going to have assistance when it comes to purchasing real estate, whether it be a gifted down payment or a strong cosigner, then you need to do everything in your power now to start saving. Reaching financial goals. Some other financial goals could be, hey, in 5 years, I want to quit my job and I want to start my business. So I need to start putting money aside now, investing it so I can comfortably walk away from my 9 to 5 and start my business. How about inflation? Who feels comfortable breaking down what they think inflation is? Again, you can use the chat box, but what do you think inflation is? You're seeing it right now. Does anyone feel comfortable describing what they think inflation might be? Price of gas, cost of goods goes up, prices of goods going up every year. Yeah, you guys nailed it. It's the idea that the cost of living is going up every year. And we're presently seeing it with grocery prices, gas prices. And one of the key reasons, aside from everything we've talked about, that you should be investing is because of inflation. And I'll paint a picture for you. If you're someone that has money sitting in a savings account and it's a large lump sum and it's meant to be your long-term savings, keeping that money in a savings, a tax-free savings, even an RSP savings, is not keeping up with inflation. Banks right now, if you look at your bank account, like you pull out a 3 or 6 month statement, they pay you nickels and dimes in your savings. So what's actually happening, and it's kind of invisible, is the balance in your savings account is actually dropping every year if you just keep it in there. So if you had like 10 grand sitting in your savings in 2023, that 10 grand would only be worth like $9,700 something dollars. So inflation is the idea that the cost of living is going up every year. And the only way to offset that is by investing your money. So if you're saving for the long term, you should not be saving in a savings account. You should be investing. You also want to offset inflation in the sense that, let's say hypothetically, the inflation rate is 5%. That would mean that you would need to simply earn 5% in order to break even. So in the stock market, I teach my students that on average, you can see returns from anywhere of 8 to 10%. And if you can see an average return of 8 to 10%, then not only are you offsetting inflation, but your money's actually growing. I love the chocolate bar example in the chat. Okay, so another reason you want to invest is to build on pre-tax dollars. So in Canada, we have something called like a retirement savings plan or a tax-free savings account. When you put money into these registered plans and then you invest it by taking the balance and throwing it into like an index fund, which by the way, if that makes no sense right now, it will by the end of the presentation. But the point being is when you utilize tax-sheltered accounts, the money that's growing underneath those umbrellas is growing tax-free. Meaning at the end of the year, when the government says, hey, you need to file your taxes, they can't treat the money that's growing underneath that umbrella as income. And finally, compound interest. Compound interest is the idea that you earn interest on interest. So going back to the example that when you have a savings account, it pays like nickels and dimes. It's the idea that, okay, I had $100 in my bank account and then my bank paid me 10 cents in interest. Well, the following month, the bank is going to pay you interest on the $100 and the 10 cents that you earned. So that's the compound effect. And we'll actually see that in a moment. Okay, so because I'm a very visual person, so I wanted to break down the difference that 5 years can make when you're investing. So we have two examples here. I also have a podcast, the link's in my bio and my Instagram. And I think in the first episode, I break this exact example down. So in the first episode where it comes to investing, I think it's actually episode 5. But so with this example, let's say we have Jasmine on the left-hand side. Jasmine is 20. She has $2,000 that her mom gave her for her birthday. So she's ready to invest that. Jasmine builds a budget, and her budget suggests that at the end of the month, she has at least $250 that she can invest. Yeah, 250 may not seem like a lot, but I'm going to show you the difference it makes in the long run. So Jasmine takes the $2,000 that her mom gave her. She takes the 250 that she has left over at the end of every month, and she starts investing. She realizes an average rate of return of about 8%. By the time Jasmine turns 65, if she keeps this up, she's going to end up with pretty much $1.4 million. So here's an example of how someone at 20 literally saved $1.4 million by the time they retired by simply putting $250 aside every month. On the right-hand side, we have Jack. Jack bought a brand new Audi. He waited to start investing. He said, hey, I'm going to wait until I get promoted. Once I'm making more money, then I'll start. It's okay. I don't have to think about retirement. I'm only 25. So at 25, Jack also has $2,000 that he puts into a retirement savings plan. From there, every month he decides, hey, according to my budget, I can put $250 aside. So he starts doing that. Similar to Jasmine, he realizes an average rate of return of 8%. By the time Jack retires at 65, he only has $927,000 saved. Now, although that's great, it's not meeting our minimum requirement of $1.3 million. And the reason he wasn't able to save as much is simply because he started 5 years too late. And the difference between Jack and Jasmine is that Jasmine ends up with $472,000 more than Jack, because she started 5 years sooner. And that's where the time and compound effect are seen. So the point being is you guys don't need a crazy lump sum to start. You just need to start. In order for Jack to catch up, he would realistically have to start investing more in order to catch up to Jasmine because he started 5 years too late. Any questions about that? I'll keep looking at the chat box. But I think this visual example should kind of inspire you to start, even if you don't have a large amount to start with. And by the end of the session, you'll know which types of vehicles make sense for you based on where you're at. Okay, so when you guys are investing, these are the three things that I want you to focus on. The first one is thoroughly analyzing any company or asset that you want to invest in, and the soundness of that business or asset before buying the stock or investing in the asset. The reason I say asset is you can pretty much everything I teach you today, I want you to apply it generally to any type of an investment vehicle, even real estate, for example. So you need to understand how that asset or investment vehicle, like a stock, has competitive advantage. If you don't understand it, you don't invest into it. The second thing that you need to do anytime you guys are investing is deliberately protecting yourself against serious losses. There's a lot of risk that can be taken in the stock market, but there's also some investment vehicles that are safer than others. And there's a strategic way that you build a portfolio from scratch to protect yourself against those losses. I'm going to teach you how to do that today. And the third thing that I always want you to keep at like the forefront is just to be satisfied. Sorry, just someone just joining. But again, the third thing that I want you to keep in mind is just to be satisfied. Don't get greedy. Don't try to like double your money, triple your money in a short period of time. That goes back to point 2, that you're not really protecting yourself against losses. Just be satisfied. If you aim to be satisfied, you'll make money in the stock market. Okay, now we're going to move on to the next layer. So now you kind of understand what investing is, why you'd want to start. The next thing that I'm going to talk to you about that you need to kind of outline and maybe even write down right now, if you